Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. So that's why we bring Mandeep in here, because he's the tech guy along with Anurag Rana and the team there at Bloomberg Intelligence, a global tech team, which Mandeep now runs with an iron fist, I am told. Mandeep, talk to us about these IPOs. Totally two different companies, ARM and Instacart. How do you view ARM? Because that's kind of the one I think that's kind of got people's attention in the sense of, is this an AI play or isn't it?
Well, so ARM clearly has a history in terms of, being that core part of how AI has evolved and how chips have evolved, because they are the IP providers when it comes to computing and all the advancements that we have seen. And what they have told us is they have increased the royalty revenue. So basically they have increased the prices and everyone is on board in terms of paying the higher prices for their technology. So that's a good sign ahead of the IPO. And I think from what we have gleaned so far, the IPO has been oversubscribed. Clearly, everyone believes this is a technology that's not going away. It can be replaced. And hence, even though the growth was slow, the fact that they can raise prices like this, it's a good sign ahead of the IPO. Instacart, on the other hand, completely different ball game. Marketplace business. We know all the marketplace businesses haven't done very well, including Uber and Lyft since the IPO.
But the marketplace business, is Amazon a marketplace business as well?
Yes, Amazon is a two-sided marketplace. Instacart is a three-sided marketplace where you've got all the grocery kind of providers, you've got the shoppers, and then you've got the consumers. The problem, and ride sharing, for example, is a two-sided marketplace. You only have the consumers and the drivers. So it's not a three-sided marketplace. The problem in a three-sided marketplace is your take rates are much lower because you have to split your take rates through two other providers. In a two-sided marketplace, it's a higher take rate. So
fascinating.
Instacart's business, the unit economics look a lot better than some of the other providers, whether it's DoorDash or Uber, simply because they layer a lot more ads. For every dollar in transaction revenue, they make about 30 cents in ads. That's phenomenal for unit economics. Problem is the top line is decelerating. They have flat order growth. Marketplaces are scale businesses. Once your top line slows, even if you make 30 cents on a dollar for ads, that's not good enough because your scale isn't growing. And that is where I think they're pricing the IPO appropriately to reflect that slowing.
That's good bet if you feel like COVID's coming back, Paul.
I do not.
I know, but I'm saying if you do,
do not.
Because that would grow their top line
would
masterfully.
That would.
At least for a
Maybe
moment.
there was a pull forward during the COVID time. I mean, all these companies grew 100% plus triple-digit growth.
So I guess for Instacart, one of the real questions will be valuation. So just walk us through kind of where this thing was valued at its peak when people were going nuts getting stuff delivered home to maybe where it is now.
Yeah, so at its peak, it was around $39 billion valuation in 2021. And that's when,
See, this is what I say, being an old codger Wall Street guy. That's Silicon Valley valuation. That's the kids. Then when you want to come to the public markets, then you got to talk to people like me. That's what happened here.
Well, I think back in 2019 when Lyft went public, they went public at a $20 billion valuation. They raised more than $2 billion in an IPO.
Right.
Well, clearly things have reset completely now, and I think
they're worth a fifth of that now.
No, Lyft is worth a gajillion. I mean,
they're worth a fifth.
Yeah,
exactly.
I thought you Uber, yeah.
So I think that's where Instacart clearly, the valuation is a lot more reasonable now. I can see the IPO pricing maybe revised upward to around 10 to 12 billion. Based on the initial pricing, it's more 8 to 9 billion. I can see it being revised slightly higher because of that ad revenue. And if they can convince investors at the roadshow that the top line will re-accelerate, because right now, as I said, it's flat order growth. That's not good news when you're, a growth story. So clearly that top line acceleration is key, but the unit economics, as I said, for Instacart look a lot healthier than all the other marketplaces, including DoorDash and Uber.
I'll tell you what, Paul, I'd rather get into IPOs in this climate than during the Lyft and Rivian, the heady days of massive valuations, because now we're also pessimistic about everything, right? Yep. Now you have Mandeep coming on going, the top line's not going to grow very much. They're going to have to cut what they are actually worth by like 4 times. And back then it was who knows? The sky's the limit, So at least now you can get in without that irrational exuberance.
I'd rather be a momentum investor than a value investor any day of the week, because I don't have to be right on the names. I just have to jump on the mo. Here, I gotta pick the name right. I gotta pick the valuation right. I gotta be all kinds of right. So, is this the beginning, Mandeep? I mean, this is gonna be a down round, to put it in the parlance of private equity and venture
for all
capital.
of them, right? For ARM, for Instacart,
So does this open up? I kind of feel like there's a stigma. There is a stigma to not doing down rounds, but now we're going to have a couple notable names doing down rounds in the public market. Do you think that's going to have an influence on the other companies to maybe consider IPOs?
There will be, and look, you're not going to see a lot more delivery companies come to the scene now. Now the market is consolidating. That's good news for the ones that are left over. So previously you had GoPuff and every new company coming to the scene trying to figure out delivery. Well, those days are over. I think VCs are quite cautious about investing in this space altogether. And I feel once you have consolidation, which is what we are seeing with DoorDash, Uber, and to an extent Instacart, that probably will be good for the unit economics of these companies.
ARM said to consider, here's a Bloomberg story, ARM said to consider raising IPO price range. How about that? That's like the old days.
Yeah, but that's because they've already brought it down by so much. They had their own owner buy a stake in them that it essentially already owned for far more than what they're going public for now.
So is this, ARM is this week, right? Like maybe a Tuesday pricing, Tuesday night for a Wednesday trade?
Yeah.
That'd be really interesting to see how that trades. Silicon Valley in general, is it still all AI?
Right now, it's all about generative AI. This year is the year of generative AI. You can lump in chatbots as well, and just overall large language models, foundational models, which is why the Apple event, if they don't talk about generative AI at this event, they clearly have a problem, because that's what everyone is hoping for, that Apple, $3 trillion company, hasn't mentioned generative AI even once in their earnings call. Yes.
Why is that? 30 seconds.
Well, because they probably haven't built their foundational model yet, and they are focused on privacy. When you think about large language models, it's built on big data sets. Apple is a company that has always been focused on privacy, and that is what makes them hard to build their own large language model like a ChatGPT or
All right, we're going to have you in again on this one, because, this kind of could be existential for Apple if they don't, at least in the minds of investors.
Dude, this morning, Gina Martin-Adams on Surveillance was talking about how important generative AI is for a brand like Hostess.
Exactly.
If it matters to Twinkie maker.
That's what I say. When you hear Tom Keene mention Twinkie and AI in the same sentence, you know something's up. All right, Mandeep, thanks so much for joining us. Mandeep Singh, he's a senior analyst. He runs all of our technology research. We have tech analysts literally all over the globe, Europe, North America, and of course, Asia. And Mandeep kind of runs that business for us, and we appreciate that.
You're listening to The Team. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
We have Rick Caruso with us. He's the founder and executive chairman of Caruso, starting out life as a lawyer and then transitioned to Caruso Affiliated Holdings, and they own, among other things, The Grove, which was ranked number 2 on Fortune's list of the 10 highest sales-generating shopping centers across the country. I've always been a fan of the mall.
You have it?
Yeah. I love the Westchester up in White Plains,
You're
for
not
example.
a Jersey person, though. Jersey, we do malls in New Jersey.
Yeah, I'm from the great state of Ohio.
Of course.
We have traditionally had big malls. At least they started, I think, when I was a kid, so I kind of grew up with them. Fast Times at Ridgemont High was like the story of my middle school. Rick, talk to us about the current state of commercial real estate, because it had been, kind of one of the big fears, I would say, of 2023, but it seems to be fading a bit as a fear.
Well, thank you. I think on the retail side, listen, we do outdoor malls.
Yep.
So all of our properties are not covered. I think that's a very different sector. But what we're seeing on our properties, consumer is still strong. Consumer spending is still up. Our growth on our properties is double digit in terms of attendance. and our sales per square foot is up. So we're having a very good year. My fear is that with inflation, with rising interest costs, I don't know how long that lasts, but right now we're running at a really good pace.
What's the occupancy of your malls in general today, maybe relative to pre-pandemic?
We're very unique. So I'm going to tell you this and you won't believe it, but we run at 100% with a waiting list. But our properties are incredibly productive. We have 3 in the top 10 in the United States. We're a different business.
Yeah.
You know, it's a very different business.
It's not strip malls. Well, what's the term that you use
No,
for
it's like Ridge Hill we have up in Westchester, Polaris in Columbus is like this. What do you think differentiates?
They're like downtown centers.
Yeah.
They're like downtown centers.
Okay.
So
but what makes it different than a covered mall?
Because we're creating an environment. Listen, a covered mall is an artificial atmosphere that you're asking somebody to go into.
Right.
And people always say,
now, we have a good one over in New Jersey, the mall of, what's it called? The Dream Mall or whatever?
Well, you and I have never been there, so how can we say it's good?
That went through a lot of problems.
I know.
But I think the difference is we're creating an environment for people to come and enjoy themselves, relax, have fun, create an environment. Very, very different.
Right.
We have dwell time. We want people to stay. We want people to just relax. And people respond to it. You know, we're tapping into the consumer experience, which I think is all important.
They'll go without even thinking we're going to a mall. They'll go because they want to visit a restaurant, or they'll even drive through occasionally.
We're not designing it with the idea that we want people to shop. We're designing it with the idea that we want people to enjoy themselves, and then they're going to go shop because they're there.
Why do you think, though, the Grove is so popular? I mean,
where is the Grove?
In Los Angeles.
In Los Angeles, okay.
It's popular because it makes people feel better. It sounds corny, but it enriches your life, and you can go there and hang out and have a cup of coffee and read the paper and really not spend a dime. Or you can go there and spend the day and spend a lot of money. But it's the trees, it's the fountain, it's the lawn, it's the flowers, it's everything, and the shopping is incidental to it, and the restaurants. And it's curated with the best retailers and restaurants in the business.
Are you adding new malls? Are you taking over existing malls? Where's some of your growth?
We've got a pipeline of new projects that we're doing, all in the format of outdoor centers, and we're going strong with it.
Are you putting them all in the Austin, Texases of the world, the Nashvilles, and where?
No, we're growing in Southern California, and we're going to continue to do that. Now, listen, we're looking in Florida, and we're looking in other areas of the country.
So you're primarily in Southern California?
Yeah.
Gotcha. Okay.
Yeah.
So, I mean, so give us a sense of how Southern California is. You got strikes all across Los Angeles and all that type of thing. Give us a sense of just Southern California in general, because we have someone here at Bloomberg in our editorial who's very bullish on California.
Yeah,
right?
Matt Winkler.
The guy who founded Bloomberg News.
Right. Yeah.
He founded Bloomberg News, and he's written a number of editorials extolling the virtues of not only Los Angeles, but even
the strength of the Californian economy, essentially.
Exactly.
I think the California economy, listen, is strong. It's a massive economy, right? Globally. But the reality is we have enormous challenges in California.
I have a viewer writing in for a question, with a question for Rick. And essentially it comes down to the same thing. It's about the economy. Viewer, listener, we're on radio, but we're also streaming on YouTube.
Yep.
He asked, do you anticipate hiring to slow on your properties as the economy slows, or as inflation remains higher, or as the consumer weakens? Are you looking forward with concern to any of those things?
Well, I'm concerned about the consumer weakening. The consumer has to weaken, right? I mean, you've got rising interest rate, and you still have inflation, and prices are high, and savings are getting lower, and the default rates on credit cards are coming up, which we've seen that data. So it has to happen. It's just a question of time. But I think all of us have to reorganize our companies around the fact that we've got a higher tenure, and it's probably going to remain high for a while. And it's chewing into free cash flow of every company. And so we have to be smarter about how we spend our money, which may mean slowing our hiring and slowing growth and slowing CapEx. I mean, it's going to have an impact, which I worry about.
Theft is something that I've heard more from retailers' earnings calls, and they call it shrink. It's just been extraordinary, and it looks organized.
It's insane.
So can you give us a sense, kind of from your perspective, what this means for the industry?
Well, here's a problem in Los Angeles County. We have a no bail system, so you can get arrested and you're out within an hour.
Okay.
Even if it's a felony. If you steal under $950 plus or minus, it's a misdemeanor. And these theft rings are organized. I mean, it's organized crime, and they're mobs. And we've got to change the rules, and we've got to get elected officials that actually have some backbone and say, we're not going to allow this to happen anymore, and let's hold criminals accountable. They need to be incarcerated if they're a ring and they're repeat offenders. And then, of course, we've got to give people a chance for, rebuild their lives and whatnot. But what's happening in Southern California right now with the smash and grabs, or in San Francisco, you can't tolerate that in business.
And
it's killing small business, by the way. Forget big business.
If you own, essentially an outdoor shopping community like the Grove, do you bring in an extra, police force, auxiliary cops? Do you try and, get the employees to do something about it? I mean, how do you fight this?
We don't want employees to engage, but what we do on all of our properties, we have armed security and we have extensive camera systems. We have equipment that can actually identify people, and so we're very sophisticated on our properties. But the problem is 90% of the businesses in LA are small businesses. They can't afford to do that.
Yep.
And they get one smash and grab, that could be their monthly profit. So what's happening, I think, in Southern California, LA, is the responsibility to keep people safe is getting pushed to the private sector because we have a shortage of cops and we have a shortage of, again, elected officials, I think, that are actually dedicated to making sure that our communities are safe. And we're picking that up, and that's not good business. We're smart for the community long term.
Is that one of the biggest challenges for Southern California in general, do you think?
I think so. I think it's a big challenge for California in general.
Yeah.
And for New York, right? Yeah. Even though we have an ex-cop here in office, and I think a lot of people expected the crime to change on the day he came in, and it hasn't.
Yeah.
And you have a big police force, which we don't have in LA.
Is that right?
Yeah, I mean, you have almost 5 times as many cops as we do in Los Angeles.
Really? I didn't know that.
Yeah.
Okay. Very interesting stuff there. Rick Caruso, thanks so much for taking the time to join us here today. Really fascinating discussion.
We ought to do the show from the Grove.
We should do that.
Let's go.
Get out to the West Coast and really dive into the economics and businesses of California.
I think we can do that. We can get some support.
I would like to do that.
We'd love to have you.
All right, Rick, thanks so much for joining us. Rick Caruso is a founder and executive chairman of Caruso, talking about the retail business and the retail business on the outdoor malls, if you will. Quite vibrant relative to kind of what you hear from other parts of some of the retail. But retail in general has been good. The consumer's been good. The question now is just kind of going forward with the higher rates and all that type of thing.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Big take story right down Matt's alley here. Monica Raymond joins us. She's the auto industry disruption reporter. How about that with Bloomberg News? She's got the story out there entitled "Germany Frets, Volkswagen is heading down the road to nowhere."
Yeah.
So, Monica, thanks so much for joining us via Zoom here. What's kind of the thesis of your story? I thought Volkswagen's going all in EV.
Oh, definitely. I wouldn't say that they're not focused on their EV strategy, but really what the concern is that Volkswagen is sort of atrophying market share in China when it comes to EVs, when it comes to competing with Tesla, when it comes to competing with BYD. And basically the company needs to sort of catch up and redo their strategy and figure out how to deliver to the Chinese market what the Chinese have come to expect. It's a unique situation because basically during the pandemic, when everyone was sort of triaging their own issues back at home, China really went all in with EVs, with their infrastructure, with supporting their startups there, and the scene completely changed. They made leaps and bounds when it came to software technology, when it came to infotainment, when it came to in-car experiences, and now Volkswagen and other legacy car makers are looking at the market and realizing, the Chinese are doing it really, really well when it comes to EVs, and they have to sort of find a way to catch up. And the bigger picture is that this is a big concern for Germany because the auto industry plays such a huge role in the macro environment and the economy. And if Volkswagen fails to get this right, it's going to have an impact on their domestic situation, on the domestic economy.
I think it's an amazing story on so many levels, Monica. The first thing that I was wondering about is, did Diess Herbert Diess leave Volkswagen in this situation, or is Bluma, not executing on the Diess strategy well enough? Then I also thought about, if this is a security issue for Germany as well as an economic issue, how much control does the state feel like it can take over this behemoth? Because if things go wrong, it's not just for the Porsche Piche family a problem, it's a problem for the entire country and economy. So I think there's so many different threads that are fascinating. What happened to the tens of billions of dollars that Diess was investing in becoming an EV maker, becoming a software company? I remember headlines out from Rauvald that were like $30 billion or $50 billion. Are they spending that money? Is it getting them anywhere?
Yeah, absolutely. Great questions all around. On the investment question,
sorry,
Volkswagen
I just thought the story moved me. Honestly, I really, really think it's fantastic. I recommend to our listeners and viewers to check it out. It blew me away this morning. So I should have read it last night. I wouldn't have been able to sleep if I did. All right, so the money.
Right. So on the money part, no, and the money is still there. Volkswagen is investing, I think, total over the next 5 years, something like 180 billion, and 2/3 of that is going to EVs. Don't quote me on that. The numbers are a bit fuzzy in my head.
It's a lot.
But there's still, it's a lot, yeah. And you're absolutely right. Diess was, in my mind and in my assessment, totally the innovator. He had the long-term vision for where the car industry was going and where it needed to go, where Volkswagen needed to go if it really wanted to compete with Tesla, and eventually the Chinese. And one of his big strategic plans or moves was this idea of vertical integration. We got to get control of the battery supply chain, and that was why he really went all in with PowerCo, creating their own battery company. He thought, we have to go in all in on software. We have to create our own software unit. We have to control that as well in order to control the profit pools that subsequently come from in-car entertainment. And so he was all about sort of focusing on what Volkswagen could do on its own, making Volkswagen into sort of more of a tech company as, the car becomes more of a sort of a living room on wheels, or sort of more like a mobile phone on wheels, that people's customer expectations have sort of moved in the direction of smartphone apps and services, and you needed to be able to offer that in car. And so his strategy was, well, let's do it on our own so we can control more of the profit pools. And that maybe turned out to be sort of the Achilles heel of Diess, in addition to his management style. But I would say there's a big difference. There's a difference between Diess and Bluma in that Diess, you're right, Diess did bring a lot of these innovative projects into the company, and Bluma is now sort of carrying those forward and bringing those along. And I would say, Bluma has totally, Oliver Bluma, the new CEO, who is also currently the CEO of Porsche, he is really he's going all in with the battery strategy. He's still supporting Cariad, the software unit, and saying we're still gonna, back Cariad's efforts 100% to create the premium platform for the Audi and Porsche vehicles, for the e-Macan, for the Q6 e-tron, and then using the company's resources to broaden their offering for electric vehicles.
I feel like they're slow to catch up, and they can't really knock the ball out of the park when it comes to range. They don't do as well as GM has 450 miles of range in their EV pickup trucks. Now they have gigantic batteries to support that, 210 kilowatt packs, but still they have it, right? And it doesn't seem like Porsche should only have one EV model out at this stage in the game. Why don't they already have an e-Macan? Why don't they already have an E version of the 911? Like, what is taking them so long?
Yeah, it's definitely the software issue. So by creating, by having a legacy car maker that really knows German engineering really well, to have them pivot and suddenly start doing software, it's a completely different process. It's a completely different ball game. It's a completely different sport. And they had to sort of learn from zero how to do it, how the processes work, how you develop software. And that led to, delays when it came to the launch of the platform that the e-Macan is going to be based on. It was supposed to be out, I think, about 2 years ago already, and that was one of the things. Audi Audi and Porsche, these models that are coming out for Audi and Porsche, these electric models, the models that are going to come from between 2024 and 2028 are supposed to make up about 50% of Volkswagen revenues in that time period. So they're, if they don't
That's
get
amazing,
that premium
considering they have
platform
like
out,
11 or 12 brands, right?
yeah, exactly. No, I mean, Audi and Porsche are really the big money makers. I mean, Porsche is no longer technically a cash cow since the IPO. They're no longer sharing their profits with Volkswagen. But for Audi, it's really key. It's really critical that they get this platform, this premium platform from Cariad out to build their model lineup. And they haven't been able to do that because of the delays. Basically, it was a struggle for Cariad for the software unit. Because they've had to do one software platform for the Volkswagen, this other premium platform for Audi and Porsche, and then they also had this SSP platform, this scalable unified platform for all the brands. That's sort of the long-time vision that Diess had, and that's sort of up in the air at this point about if and when that's going to come to fruition.
Hey, Monica, thanks so much for joining us. Really appreciate getting some of your time. As Matt mentioned, a fantastic piece of work there. Monica Raymond, autos industry disruption reporter for Bloomberg News, out with a big take story today on the Bloomberg terminal entitled "Germany Frets. Volkswagen is heading down the road to nowhere." So check that out on the terminal or Bloomberg.com/big take. Those are our really deeply reported stories. Great stuff. Highly recommended.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
There are old skydivers and bold skydivers, but there are no old, bold skydivers. That's a good one. I guess you can apply that to investing, as certainly our next guest does that very well. Jessica Rabe joins us. She's a founder of Data Trek Research. We love the folks at Data Trek. Lots of really smart research comes out of there.
Now, you said Rabe, and I would think it's Raba.
I went Rabe.
Let's hear
Jessica,
from
what say you?
Jessica.
Ray, you're correct.
Boom.
Thank you so much for having me, Matt. I'm very excited to be on.
All right, Jessica, I like how you kind of bring together the skydiving thing, which, by the way, we have to talk about that at some point. Who does that willingly? And investing. So how do you bring the two together?
Sure, yeah. So to me, skydiving is an amplified version of life and even investing, in that it's a masterclass in risk management. So like you said at the top, the saying there in skydiving is a very common one. There are old skydivers and bold skydivers, but there are no old, bold skydivers. So no matter anyone's experience, both skydiving and investing are process-driven disciplines with small margins for error. So ultimately, it helps teach you how to confront natural human fear and overcome it by sticking to a process, staying present, and it's very important to remain calm in high pressure situations.
All right, so
I have to say that I love skydiving, but I'm not licensed, so I still have to get strapped to a big man's back or to his chest. Unlike Jessica,
how many
because
times have you jumped out of a plane?
I've gone 7 times.
Wow.
And Jessica, I'm guessing you've done more.
Yes, I'm still a baby in the sport, but I've done 114 solo skydives at this point.
Wow. And do you pack your own chute, or how does that all work? I'm wondering.
Yep, that's part of getting licensed. You have to know how to pack your own parachute, and quite frankly, you want to know your own equipment, and you want to know how to pack, because then the way that your canopy opens is more reliable,
so
and you trust yourself.
I was struck. I read your note as soon as I saw it hit my inbox, and I thought it was really cool, the parallels between investing and skydiving that I'd never thought of. The only difference for me, and probably for most people listening in terms of retail investing, is I don't pack my own chute in the markets, right? I don't even have the ability to know how to do that. I need to leave it to people like you and Nick to pack my chute for me, because I just don't have the time to do the research, if you know what I mean.
Yeah, sure, absolutely. And yeah, I mean, so there's so many parallels between investing and skydiving for really all levels of experience. So, one of those is just sticking to a process. There are fundamentals in skydiving that keep you safe, whether it be checking your gear, remaining altitude aware of, or knowing how to fly and land in different conditions. So you can do most of a skydive right, but make one wrong move in the last 200 feet or so and face serious consequences. The same is when it comes to investing, straight from core guidelines from idea generation to taking profits or losses. And any type of investor, from a novice to a 20-year veteran, can pay the price.
All right, so I like this one. Anticipate other participants. So I guess in skydiving, you got to have that situational awareness to know what's around you. But I guess that kind of makes sense in investing as well.
Oh, yeah. So I can do everything right on a jump, but get hurt by another skydiver, whether that be colliding under free fall or under canopy. So you really have to prepare not just for yourself, but you have to anticipate other people. It's just like riding a motorcycle, which I also do. You constantly have to have your head on a swivel, and that's much of investing too, is anticipating not just what you're going to do, but what other market participants are going to do, especially when it comes to how they respond during crises. That's how a lot of volatility is created, is by other market participants and how they respond under pressure.
Yeah, I would argue in motorcycling, especially, motorcycling on the highway or in public roads, paying attention to what other people are doing is far more important than paying attention to, I'm not going to make many mistakes. The motorcycle stays up by itself as long as, I'm putting in the right inputs. So the most important thing is watch out for that car or
You're
truck.
not one of those crazy people on the Garden State Parkway that zoom in and out of cars doing like 100, 120 miles an hour?
I try not to. Jessica,
Jessica's laughing over there.
That's like a bold skydiver, right? Those people don't last very long.
You don't want to be too bold, and that's why it's a motorcycle riding too is a perfect example. Whether it be skydiving or motorcycle riding or investing, is you have to plan for adverse events. There are certain forces out of our control, whether it be weather or other skydivers and skydiving, or economic and geopolitical shocks in investing. The best we can do is stay aware of the risks and plan for them. I see skydivers with thousands of jumps still practicing their emergency procedures in the plane ride up to altitude. So that way, muscle memory kicks in should they need to cut away their main parachute and deploy their reserve parachute in the event of an equipment malfunction. And that's the same with investing. People know at DataTrek, we have a long-standing recommendation to add risk exposure when the VIX gets to 28, 36, and 44, because these are 1, 2, and 3 standard deviations above the long-run mean, and therefore signal excessive investor fear. So yeah, investing, skydiving, motorcycle riding, you always have to be on your toes and be ready for anything.
All right, so I'm looking at some of the photographs you've attached to your note here, and they're making my stomach literally queasy as I look at them. What's the highest altitude that you've done a jump from?
So I jump at Skydive Sussex, and the nice thing about that drop zone is they go all the way up to 14,500 feet.
Yeah. Is that you hanging off like a helicopter or a plane or something like that?
Yep. I did my first few helicopter jumps a few weekends ago, so that was certainly very, very fun.
That is crazy.
Because the jumping out of a helicopter is different than a plane. With a plane, you have all the relative wind coming at you. With a helicopter, you jump into dead air.
Jesus, that sounds like fun.
Yeah.
Now, I was wondering if you make these parallels, with skydiving, you want to be pretty conservative, and in investing, you do have a little bit of a risk tolerance, right? So, how do you limit yourself, or how do you stop yourself from just buying 10-year treasuries right now?
Yeah, I would say that you have to, in both skydiving and investing, you have to assess your abilities honestly. So in skydiving, it's very important to know your skill level and also stay within your personal risk tolerance. So that means only jumping in winds or joining group formation skydives that you believe that you're confident enough to be able to land safely, or also confident in others' abilities that you can execute the skydiving plan safely. There's a saying in skydiving: it's better to be on the ground wishing you were in the sky than be in the sky wishing you were on the ground. And that's a big part of the job for investors or financial advisors. It's just doing what will keep your clients in the game by knowing your own limits or your clients' limits. Just because you can doesn't mean you should. And virtual currencies are a great example that many people learned that hard lesson over the past 2 years.
So
virtual currencies.
So what's the next step for you in terms of skydiving?
There's so many disciplines in the sport, so there's just always ways to constantly improve and learn something new. So yeah, a lot of people wonder, they think skydiving's crazy. You know, what's the appeal? And I'd say there are three main appeals to skydiving, at least for myself. Number one, I like pastimes that push limits and require mental focus. So skydiving obviously fits that description, as does motorcycle riding, as we discussed. The other thing about skydiving is it's a really wonderful, diverse, and welcoming community. I have friends in the sport from all walks of life. One's a famous rapper, the helicopter jump that you referenced. I did my first helicopter jump with the rapper Redman, so that was super fun. Other people are computer coders, to helicopter pilots. I've met a bunch of cool women in the sport, and we all connect around a common passion.
All right. Well,
and thirdly, it allows me to be present and take a fun break from the grind of Wall Street as much as I love it. So,
all right.
In portfolio construction terms, I'd say it's my uncorrelated asset with high returns on investment.
Very nice. I'll let you go with that. Jessica Rabe, founder, Data Trek Research. Appreciate getting some of your time.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's talk coal, man. We talk a lot about eco kind of green energy. We don't talk a lot about coal. It's got to be tough to be in the coal business in a world that's going green, but we have found someone who does that very well. Randall Atkins. He's the CEO of Ramaco Resources. Trades on the NASDAQ, METC. I get it. I get the ticker, Met Coal. He joins us live here in our Bloomberg Interactive Broker studio. Of course, the highlight of his career, obviously, graduated of the Duke University. But I finally found somebody who did it before I did. I mean, so not, just landed there. Randall, I'm looking at your background. It's not like you're one of these people that came up in the coal business your entire life. A lot of banking, a lot of investments, a lot of finance. Why did you get into the coal business?
Got into the coal business because it was sort of a distressed business. It was a play that, frankly, we stepped back even 5 years ago. Most of the public companies were all in bankruptcy.
Yep.
So if you could start one from scratch, kind of reverse engineer it correctly with little debt, and sort of maximize the asset quality, we have proven that you can make a very good go in this business. And as our expression is, we view coal in a manner which coal is too valuable to burn. So we approach it a little differently than most.
So how do you address what I assume must be a shrinking market? Is it in this country? Do we use less and less coal every year?
Split the market into two different pots. One is thermal coal, and that answer to your question is yes, it is probably a declining market. Met coal, which is what we focus on, is basically a precursor to make steel. So that business is not declining, and indeed internationally, where we probably place upwards of 2/3 of our market, is growing. Obviously, the Asian market is the principal growth factor.
So 2/3 of your business is outside the U.S.?
Correct.
Okay. So talk to us about just the competitive landscape. I can't even think of other coal companies out there. Who else is out there that you compete with? Like, who is the competitive marketplace? Is it other
BHP
U.S.
Billiton?
Yeah, I guess. Yeah. So what's the competitive landscape?
We wouldn't compete so much in the Australian market, which has pretty much got a lock on a lot of the Asians just because of the proximity of logistics. But domestically, we would compete with companies like Alpha, Arch, to a lesser extent Peabody, Warrior. Those would be some of the names.
So met coal, coking coal, still desperately needed to produce all the steel that we need. What does the growth in that industry look like?
The growth in that industry is basically, I always say, met coal is a proxy for steel, steel is a proxy for GDP. So if you look at basically general economic trends, whether it's in the U.S. or overseas, it pretty well met coal ties to the growth in the general economic situation of most of the countries.
All right, so I'm looking at your financials here on the FA function on the Bloomberg terminal. I got top line going kind of mid-single digits, EBITDA margins mid-20s, free cash flow positive. Mm-hmm. What's the growth driver for your business? Do you acquire additional mines? Do you develop further what you've got? How do you grow your business?
Sure. Well, we're actually the only domestic coal company that's projecting to double in size from where we sit right now. So we have decided to grow organically without buying existing mines. We basically have taken properties where we, in essence, buy the reserve and develop that, plan it, and then market it from there. So we will jump from about 2.5 million tons last year to about 3.5 million tons of production this year, ultimately to about 6 to 7 million tons.
I look at the stock price and I wonder what happened 2 years ago. All of a sudden it just goes boom on the rise at the August-September 2021 part of the chart. What happened there?
Basically, after that, you had sort of an economic decline. You had after effects of COVID, you had a different market situation. Basically, in the August and September periods is when you find almost 100% of the domestic sales occur in the U.S. So that was a tough period in domestic sales. A lot of the coal companies dropped in that same time period.
No, but you jumped. I'm looking. So 2021, your stock went from 250 to, I'm going to say 12 at the end of the year.
Right.
It was the end of the pandemic, which is why I think it's so interesting. Usually you see these stock moves right around 2020, depending on what the company is. But you climbed high into 2021, 2022, and now you're holding at about $8.
Right. Our jump was primarily based on a market recognition that we had gone from being sort of a small-time producer into becoming into the ranks of a larger producer. When we get to the 6 to 7 million ton size, we will be almost an equal size in terms of the met coal production with most of the major coal companies, which frankly still have got a predominant thermal mix. And that's frankly the drag on most coal stocks, is that there's not a market differentiation between thermal and met.
So what's the future of coal in this country, this energy? Is there always going to be a place for coal, or it just seems like, if you talk to some of the more cleaner energy folks, they would like to see that go to zero?
Yeah. So I have been a proponent for about 10 years that, as I said, there's a higher and better use for coal. Coal is too valuable to burn. I go back to really 100 years ago when coal was used for a variety of things that had more of a chemical nature. So we have been working with the Department of Energy and some of the national labs in creating new uses for coal, where you can convert it into things like synthetic graphite, graphenes, carbon fibers, and frankly that took us into the rare earth business, where 10 years ago I didn't know the difference between rare coins and rare earth, but we have found that connected to coal seams. So the future of coal I see is having three legs to the stool. One for thermal production for combustion, one for steel production, and the third leg of the stool will be higher tech uses for alternative carbon products.
What are the rare earths that you're finding, and how are you doing at getting them out?
We have found a spectrum of about 14 different rare earths, and frankly 30% of what we found are concentrated in the heavier magnetic rare earths, which are frankly the more valuable ones. Rare earths are measured in parts per million, so it's unlike the bulk coal business.
Yep.
It's more like you're looking for diamonds almost, and it's more of an industrial chemical business than it's a mining business, because once you find it, that's only half the battle. The trick is to separate the rare earths,
right,
and get them processed in a way that they then become commercially usable.
Hey, Randall, thanks so much for joining us. Really appreciate you coming in here. We don't talk about coal that often, so it's a fascinating discussion. Randall Atkins, he's the CEO of Ramaco Resources. Thank you. Symbol METC.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
J.M. Smucker agreed to acquire Twinkies maker Hostess Brands for about $5.6 billion, furthering a growing consolidation trend among the companies that stock the shelf-stable aisles at the heart of supermarkets. Do we have an expert on this business? We absolutely do. Diana Rossetto Pena, she's an equity research analyst, follow all the consumer space for Bloomberg Intelligence. Diana, you were like one of our first BI analysts. You're like an original.
You're aging me.
Absolutely. I mean, you're there from just the get-go, and she's just become one of the top analysts out there covering the consumer space. Diana, what do you make of this deal? Smucker's buying Hostess. What's going on here strategically?
Yeah, well, strategically for Smucker, this will be a more of a mixed deal for Smucker in terms of on the sales side. It's definitely positive. It's a company that is growing in the mid-single digits compared to consumer foods, the consumer foods segment for Smucker, which is growing in the low single digits. So definitely on the sales side, it's going to be a positive. Now, if you go down the P&L, that's probably going to be a little bit more complicated.
Why is that?
Because EBITDA margins are not necessarily going to be as positive as the company is stating in our view. The company's call this morning said that they Hostess had a 23% EBITDA margin, which is going to probably be about the same as the consumer food segment for the company going forward. So we don't necessarily see a lot of accretion on that end.
I feel like there's room for real improvement on execution of Hostess product sales. You know, we have interviewed the CEO of Hostess a couple times, and as a result, I always go out and look for their products in stores, and I see that they do have like sometimes separate areas or specific displays, but the products aren't stocked very well, and there's just not enough attention drawn to them in the points of purchase. Couldn't they improve that?
I think that is something that attracted Smucker. It seems that Hostess has been increasing innovation and points of sale, as you mentioned. And I think they're probably going to benefit from the supply chain leverage that Smucker has. And it's also, in terms of Smucker, it will give them a little bit more exposure on the convenience side, which is about 40% of Hostess sales.
So I'm a big fan of the Hostess brands, but there's some people out there that maybe even during the pandemic, I don't know, maybe they went to more of those, ring dings and all that kind of good stuff that we all love. But maybe now they're coming back and going back to more healthier food. What are the trends you're seeing out there?
So basically, it's consumers in the United States, they say they want one thing and they actually do another. So yes, you're right. People want to be healthier, and definitely the pandemic was a big catalyst for people going and purchase more of the indulgence snacks. I think there's still a little bit of growth on that aspect. People seem to be a little bit more permissible in the indulgence side. And I think that is probably going to fuel growth going forward.
I mean, Twinkies, obviously.
Boom.
And then the cupcakes. I like the orange ones, but they have the chocolate, and the Ding Dongs are a classic. The Ho-Hos,
Yep.
Can't forget about those. I have always been a fan of the Chocodile.
Really?
Which is a Twinkie essentially dipped in chocolate.
Wow,
I've never really liked the Snowballs, but they're there.
Snowball.
The Zingers. And then, I mean, they're just like classic brands. I feel like instead of just selling them at the 7-Eleven or the Duane Reade, they should be sold in, these trendy, like Urban Outfitters should sell these things, right? Because
but you can't fit under clothes though, so that would be a little bit of lack of synergy.
Why is James Smucker stock down 6% today?
Well, obviously it has, as you know, there's also the acquirer curse playing into that. But like I said, I think it's more of investors I don't want to say not believing, but being a little bit wary about the bottom line for this acquisition and how accretive it's going to be on the EBITDA margin.
Are we seeing more consolidation in the grocery space? If so, why, or what's happening out there?
Well, we actually, I have been fairly active in terms of writing because Campbell Soup a few weeks ago bought Sovos. So
that's right.
Yeah, so that is definitely, it seems that acquisitions seem to be ramping up in the second half of the year. It really is in terms of, it's not unusual. I think we're going back to patterns compared to before the pandemic, that all of these big companies are looking for growth and they're paying a pretty high price for it.
How can Hostess, go into bankruptcy, not just once, but twice? Was that just, who
bad
can
management?
Who can't sell Twinkies? What happened? It was maybe before your time, but was it just, again, as Matt suggested, maybe just some bad management there?
Yeah, it was a combination of bad management and at the same time, it was lack of innovation. The brands were falling out of flavor, and I think now with more innovation and with the strong supply chain leverage, I think that they're probably going to be expanding into that.
Do you expect more M&A going forward in this space?
I think so. I'm a little worried about the premiums that we're seeing and the leverage expansion. Obviously, Smucker, it's their balance sheet is going, that net leverage is going to be 4.4 times.
That seems high.
That's
fine for my industry, the media
high.
industry, because we grow our EBITDA 15 to 20%. You guys don't grow your EBITDA that fast.
Exactly. And usually we should be able to see leverage in the 3 times. But now when we're looking at deals that are expanding into 4 times, it makes people a little nervous.
I wonder what are the other brands out there that are on the block? Like, do we know Hostess was on the block? Do we know? Or was this a surprise?
Well, apparently, according to Smucker management, the acquisition was a surprise. They themselves actually divested some of the food brands for pet. So divestitures seem to be also on the block.
Smucker's has coffee, right? They make Dunkin' coffee for sale. They have Folgers.
Yeah.
They obviously do Jif peanut butter and the jellies.
And you're a Jif guy.
I love Jif. I will eat Jif peanut butter straight out of the jar in a spoon.
I'm a Jif.
Wow.
Jif. It's so
you
delicious.
break the tie. Okay.
And crunchy.
Yes.
But Smucker's also does Meow Mix and Milk-Bone, right? Are they getting out of the pet food business?
Yes, they are actually. Yeah. They're concentrating on the pet snacks category, which is
pepperoni.
Yes, exactly. Yes, Milk-Bone. So, but that is, I think, one of the arguments against the deal is this going to be a Big Heart pet brand 2.0? Back in 2015, the company acquired these Big Heart brands for $5-point-something billion. Leverage was also 4 times EBITDA. So and now they're divesting a lot of brands of it. So people are concerned about that.
What's your thoughts on Chewy? We've got about 20 seconds.
Chewy, they're growing on their net sales per active consumers, and active consumers seems to be a pain point for them so far.
All right, good stuff. A reader just kind of writes in, Peter Pan peanut butter is where it's at.
That's not the case.
That's not a strong take?
Well, you know what? I don't actually. It's been a long time. I'm going to go out right now because I'm leaving.
Okay.
And I'm going to go get a
upstairs
jar
we have Smuckers.
of Peter Pan. I'll go over to the Dwayne Reed and pick one up and see how it goes. But I think Jif is still the reigning champ.
All right. Diana Rosado Pena, equity research analyst for Bloomberg Intelligence, breaking down this deal.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's talk about ad tech, digital advertising, all that fun stuff, the part of the advertising pie that continues to put up some really solid numbers. And you think about the digital advertising, the Facebooks, the Googles. I use the old school words, not Meta or whatever the other one is. But there's technology behind that, and that is a fascinating part of the business. Our next guest is all over that stuff. Megan Clarken joins us. She's the CEO of Criteo. It's a NASDAQ-traded company. CRTO is the ticker to put into your Bloomberg terminal. It's a French company based in Paris. Megan, thanks so much for joining us here in a Bloomberg Interactive Broker studio. What do you guys do at Criteo?
We're an ad tech company, as you said. We focus in on commerce media, retail media.
Retail media. What is retail media?
Well, retail media is the lighting up of advertising on retailers' sites, or even broader commerce sites like Uber. They're now selling advertising, and it's incredibly successful. It's the fastest growing area of digital advertising. What Criteo does is we enable all of that for them. We make sure that the right ads gets to the right person on the right side at the right time. And we also make sure that their inventory is showing up for the demand side, or the advertisers and the agencies who are looking to spend their advertising dollars across sites. So it's competing, if you like, with traditional media advertising. It's competing with Google. It's competing with search. It is the new wave of advertising across retailers.
What's a typical advertiser in that part of the marketplace? Is it a Coca-Cola trying to do some brand advertising? Is it a car agency trying to get me to go out and buy something tomorrow?
Yeah, it's all of that.
Okay.
So they now see a real opportunity getting in front of audiences who are actually shoppers. They're actually on their buyer journey, and they're really close to the point of sale, as opposed to on a social site where it's a conversation that's happened, and they might happen to see the Pepsi ad, and it might spark a sort of thought to go. If you're actually on Costco and you're getting a Pepsi ad and they stock Costco, you're very close to that point of sale. Right. So it's a very viable advertising channel for all of those brands.
So your clients are the Costcos of the world as
Correct.
Opposed to the Pepsis of the world?
Well, we service both.
Okay.
Because we light up the advertising for Costco, for Macy's, for Best Buy, for half of the biggest retailers in the US. We power that advertising. But we also make that advertising inventory available to the Pepsis, to the Cokes, we have 2,600 brands that we support to try to bring their dollars into that retail media space.
All right, how has that market, that's been, when you think about the global advertising pie and you take the traditional media, not growing, declining, depending upon what you're looking at, and you look at the digital piece continues to grow.
Yeah.
And that was, when I used to cover this 4 or 5 years ago, still growing at 20%.
Yeah.
Where is the digital dollar spend growth rate kind of over the next several years from your perspective?
Well, if we think about retail media, the retail media marketplace is by 2025 going to be worth about $110 billion.
Okay.
Now, if you think on top of that, there's a star player in there right now, which is Amazon.
Yep.
And Amazon's been doing this for 6 to 10 years. Now, Amazon have last quarter posted about $11 billion worth of advertising and have a run rate to about $40 billion by the end of the year. And if you think of traditional TV, over all of the TV players, that's a $66 billion market.
Yep.
So Amazon in the retail space, $40 billion. All of TV, over all of the years that it's been playing, about 66, is this real opportunity in retail media that's just exploding.
How are retailers in general, how are they as clients adapting to this whole concept of you can monetize your kind of your user base, that whole concept, through advertising and other things?
Well, it's interesting because they're not media players,
right.
You know, they're retailers, but they look at Amazon and they look at Walmart and they look at Instacart and they look at how valuable this proposition is. And this is where Criteo comes in, because we come into them and say, hey, we've got this platform. We will represent you. We'll make sure that the ad tech works for you, and we'll make sure that you're seen as compared to others for all of the advertisers that we represent and all of the agencies, the 5 big holding companies that we represent. So we create an ecosystem around retail media, and they love that because they don't have to think this through themselves.
Right. How do the agencies think about retail media? It's not going to ABC and buying a 30-second spot on the Super Bowl or whatever. So it's a different type of channel, how do they view it?
Yeah, it's different. These are all tactics. So if you think of an agency, their job is to make money for their brand.
Yep.
And so depending on what the brand is and what their objective is, they'll either go to broad-based advertising, brand advertising across traditional TV, or they'll go into a big audience on a social environment, a research environment, or they'll go to a precision, a point of sale across retailers. And so they think about that as a new way to get a return on investment for those brands, for those advertisers.
So we think about retail, I think, Amazon or Walmart, but there are adjacent retail industry, travel, hotels, all that kind of stuff. How is that business evolving? Because people are spending a lot of time on those sites as well.
Definitely. So we see retail media as sort of the core of this. And then there's this broader opportunity called commerce media. And that's exactly what you're talking about. So Uber was a client that we signed last quarter. And if you go to Uber Eats, you see Criteo in action. You see the sponsored ads appearing when you're searching for a product. You see their display advertising, their video advertising. And they look, for all intents and purposes, like Amazon when you go there. So it's really interesting to see how that's going to unfold.
It's interesting. We see this a lot. Companies, platforms have this audience, this unique audience, and the question is, how do you monetize it? The current example I have, and I've mentioned this to the company, is Peloton. They're searching for revenue, and I'm like, you've got X number of millions of people, and they're crazy people, because I am one of them, and as my household, there's no... You need to go down to Peloton people and start pitching them to monetize, start putting some ads on there.
But it's so true. I mean, they're a valuable audience, and if they're shoppers or they're in that mindset to buy a product related to physical fitness, then they're prime candidates.
And that is that is kind of what you guys do, and kind of what a lot of the smart people in the ad tech space are trying to enable for folks to monetize their audience. Megan Clarkin, thanks so much for joining us. Megan is the CEO of Criteo. Again, a NASDAQ traded stock. I like to flip these things around all the time. CRTO is the ticker. 7 buys, 6 holds on the stock, and 1 sell. So a little bit divided street there.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.